There's a quiet shift happening in global finance that most people aren't paying attention to. While news cycles obsess over daily market movements and political theater, a much larger force is repositioning itself on the world stage. China controls approximately $8 trillion in financial power. That's not an exaggeration. That's not clickbait. That's the combined weight of their foreign exchange reserves, U.S. Treasury holdings, sovereign wealth funds, and strategic financial assets accumulated over decades of calculated economic policy. To put that number in perspective, $8 trillion is larger than the entire economy of Japan. It's more than 3 times the GDP of the United Kingdom. It's a sum so vast that even small movements in how this capital is deployed can send ripples through every market on Earth. And right now, those movements are beginning. I'm not here to tell you the sky is falling. I'm not here to sell you fear. What I am here to do is walk you through what's actually happening, what it means for your financial future, and how you can position yourself not just to weather this shift, but to navigate it with clarity and confidence. This isn't about politics. This isn't about taking sides. This is about understanding one of the most significant financial recalibrations in modern history and preparing accordingly. Because whether you hold stocks, bonds, real estate, or simply keep cash in a savings account, the decisions being made in Beijing today will affect the value of those assets tomorrow. Let's begin. First, we need to understand what we're actually talking about when we refer to China's $8 trillion position. This isn't a single pile of money sitting in a vault somewhere. It's a complex web of interconnected financial holdings that have been built systematically over the past 3 decades. The centerpiece of this structure is China's foreign exchange reserves, approximately $3 trillion at current count. These reserves are held primarily in US dollars and dollar-denominated assets. Within those reserves sit somewhere between $800 billion and $1 trillion in US Treasury securities. That makes China one of the largest foreign creditors to the United States government. Beyond official reserves, Chinese state-owned banks, sovereign wealth funds, and government-linked investment vehicles control several trillion more in global assets. When you add it all together, you arrive at a figure that represents unprecedented economic leverage. Now, here's where it gets interesting. For years, this arrangement worked beautifully for both sides. China accumulated dollars through its massive trade surplus with the United States. American consumers bought Chinese goods. Chinese authorities recycled those dollars back into U.S. Treasury bonds, helping to finance American government spending and keep interest rates low. It was symbiotic. It was stable. It was the foundation of what economists called Chimerica, the intertwined economic relationship between China and America that defined global commerce for a generation. But symbiotic relationships only remain stable when both parties continue to benefit from the arrangement. And right now, the calculus is changing. Think about what's happened over the past several years. Trade tensions have escalated, technology restrictions have been imposed, sanctions have been deployed as economic weapons with increasing frequency. The pandemic exposed the fragility of globalized supply chains. Geopolitical tensions have intensified across multiple fronts. Each of these developments has prompted Chinese policymakers to ask themselves a fundamental question. Is it wise to hold the majority of our national wealth in the currency and debt instruments of a nation that increasingly views us as a strategic competitor? The answer increasingly appears to be no. This isn't speculation. We can see the evidence in the data. China has been methodically reducing its holdings of U.S. treasuries for years, not in dramatic, market-disrupting dumps, but in steady, strategic reductions. From a peak of over $1.3 trillion in 2013, Chinese treasury holdings have declined by roughly 25%. Simultaneously, China has been diversifying its reserves into gold, increasing its gold holdings consistently since 2018. The People's Bank of China has been one of the most aggressive central bank buyers of gold in the world, adding hundreds of tons to its reserves. They've also been internationalizing the yuan, establishing currency swap lines with dozens of countries, creating the cross-border interbank payment system as an alternative to SWIFT, and pushing for the use of yuan in international trade settlements, particularly in energy markets. Most significantly, China has been investing heavily in hard assets, infrastructure projects through the Belt and Road Initiative, strategic stakes in commodities, control over critical supply chains, and technology that could reduce dependence on Western systems. This is financial diversification at a national level. This is risk management writ large. This is a superpower slowly, methodically reducing its exposure to another superpower's currency system. And this is where things get complicated for American investors. Let's talk about what happens when a major holder of U.S. debt reduces their position. When China sells U.S. treasuries, someone else has to buy them. That's how markets work. If demand doesn't increase to match the supply, prices fall. And when bond prices fall, yields rise. That's the inverse relationship that governs fixed income markets. Rising yields on treasury bonds have cascading effects throughout the entire financial system. Higher Treasury yields mean higher borrowing costs for the U.S. government, which increases the deficit and debt service payments. They mean higher mortgage rates, which affects real estate markets. They mean higher corporate borrowing costs, which affects business investment and stock valuations. They mean more attractive returns on safe assets, which pulls capital away from riskier investments. In short, when Treasury yields rise significantly, everything gets repriced. Now, you might be thinking, hasn't the Federal Reserve been buying treasuries to manage this exact situation? Yes, they have. Through quantitative easing and other monetary policies, the Fed has absorbed tremendous amounts of government debt, especially during crisis periods, but that approach has its limits. The Fed has already expanded its balance sheet to unprecedented levels. Continued expansion raises concerns about inflation, currency debasement, and moral hazard. The Fed is also now in a position where it's trying to reduce its balance sheet through quantitative tightening, not expand it further. So if China continues reducing its treasury holdings, and if the Fed is constrained in its ability to absorb that supply, who fills the gap? Either other buyers step in at current prices, or yields have to rise enough to attract new buyers. Either domestic investors increase their treasury purchases, or foreign buyers from other nations take up the slack, or the market reprices to reflect the new supply-demand dynamics. Each scenario has implications for your portfolio. But here's what makes this situation particularly complex. This isn't just about treasuries. China's broader financial repositioning affects currency markets, commodity markets, equity markets, and real estate markets globally. When capital flows shift at this magnitude, the effects are systemic. Consider the dollar itself. The US dollar's status as the world's reserve currency is one of America's greatest strategic advantages. It allows the US to borrow cheaply, run persistent deficits, and project economic power globally. This privilege rests on continued global demand for dollars and dollar-denominated assets. If major economies like China systematically reduce their dollar exposure and promote alternatives, the dollar's dominance could gradually erode, not overnight, not in a sudden collapse, but in a slow structural shift that changes the financial landscape fundamentally. A weaker dollar has winners and losers. American exporters benefit, holders of foreign assets benefit, but American consumers face higher import prices. Foreign holders of dollar-denominated debt see the real value of their holdings decline. Inflation pressures can intensify. Understanding these dynamics isn't about predicting exact outcomes. It's about recognizing the forces in motion and preparing for a range of possibilities. History offers us a valuable lens through which to view this moment. The current situation isn't without precedent. Reserve currency transitions have happened before, though rarely in living memory. Britain's pound sterling was the dominant global reserve currency for much of the 19th and early 20th centuries. London was the financial capital of the world. British debt was the safest asset. The pound was the currency of international trade, but World War I shattered that arrangement. Britain emerged from the war deeply indebted, its economy strained, its global position weakened. The United States, meanwhile, emerged as a creditor nation with a growing, dynamic economy. The transition wasn't immediate. Sterling remained important through the 1920s and beyond, but the trajectory was clear. By the end of World War II and the Bretton Woods Agreement, the dollar had definitively assumed the mantle of global reserve currency. The lesson here is that these transitions happen gradually, then suddenly. There are long periods of structural adjustment where both the old and new order coexist. Then there are catalytic moments, wars, financial crises, policy failures, that accelerate changes that were already underway. We may be in one of those long transitional periods right now. Another relevant historical example is the Plaza Accord of 1985. Major economies, concerned about U.S. trade deficits and currency misalignments, agreed to a coordinated intervention to depreciate the dollar against the Japanese yen and German Deutsche Mark. The intervention worked, perhaps too well. The dollar fell sharply, but the consequences were complex and unexpected. Japan's currency appreciation contributed to an enormous asset bubble and subsequent lost decades. Germany's economy adjusted, but faced its own challenges. The U.S. trade deficit persisted despite the weaker currency. The point is that even coordinated, intentional efforts to manage global currency relationships produce unpredictable outcomes. The current situation, where China is unilaterally repositioning without coordination, introduces even more uncertainty. More recently, we've seen smaller-scale examples of what happens when major holders of dollar assets reposition. Oil-producing nations, Russia, and others have diversified away from dollars in recent years. Each time, markets absorb the shift, but not without volatility and adjustment periods. The difference with China is scale. When the world's second-largest economy, with $8 trillion in financial power, makes strategic shifts, the ripples are larger. The adjustment periods are longer. The systemic implications are deeper. None of this means catastrophe is inevitable. Markets are adaptable. Economies adjust. New equilibriums emerge. But adaptation takes time, and during transition periods, volatility increases, and old assumptions stop working. Let's talk about how people tend to respond to this kind of information. There are typically three camps that emerge when a major financial shift comes into view. The first camp dismisses it entirely. China would never do anything to destabilize the system because it would hurt them too. The dollar is invincible. This has been predicted forever, and it never happens. This is normalcy bias, the tendency to believe that things will always function the way they've functioned in the recent past. The second camp panics. The dollar is collapsing. Get out of everything. Buy gold, guns, and canned goods? This is catastrophizing, the tendency to extrapolate worst-case scenarios and act on fear rather than analysis. The third camp takes a measured view. They recognize that significant changes are underway. They understand the mechanisms by which those changes might affect markets. They prepare proportionally to their assessment of risk without abandoning their broader investment discipline. Which camp you fall into will determine how well you navigate what comes next. Market cycles are driven as much by psychology as by fundamentals. Major transitions create uncertainty. Uncertainty creates anxiety. Anxiety creates volatility. And volatility creates opportunity for those who remain clear-headed. Think about what happened during the 2008 financial crisis. The underlying problems, over-leveraged financial institutions, complex derivatives, housing market excess, were building for years. Some analysts saw it coming. Many dismissed the warnings. When the crisis hit, panic ensued. Assets sold off indiscriminately. The S&P 500 fell more than 50% from peak to trough. But those who maintained discipline, who understood that markets eventually stabilize, who had the emotional fortitude to stay invested or even add to positions during the panic, recovered and ultimately prospered. Those who sold at the bottom, who let fear dictate their actions, locked in permanent losses. The current situation is different in the specifics, but similar in the psychology required to navigate it successfully. We're not in a crisis moment right now. We're in the early stages of a long-term structural shift. These shifts create periodic volatility. They create periods of uncertainty where traditional correlations break down. They create moments where patience and discipline are tested. Your ability to navigate this successfully depends less on predicting exactly what will happen, and more on being psychologically prepared for a range of outcomes. Beyond China's specific actions, we need to understand the broader macroeconomic context in which this shift is occurring. The world is grappling with multiple major economic forces simultaneously. First, we have unprecedented levels of global debt. Government debt to GDP ratios in major economies have reached levels rarely seen outside of wartime. This debt burden creates constraints on policy flexibility and increases the temptation to inflate away obligations. Second, we have aging demographics in most developed economies. Aging populations means slower economic growth, higher dependency ratios, and increased pressure on social safety nets. This affects everything from labor force participation to savings rates to consumption patterns. Third, we have technological disruption accelerating across industries. Artificial intelligence, automation, and digital transformation are reshaping how economies function. This creates opportunities, but also displacement and adjustment costs. Fourth, we have climate change and the energy transition. The shift away from fossil fuels represents a massive reallocation of capital and a fundamental restructuring of energy systems built over more than a century. Fifth, we have deglobalization and the fracturing of the integrated global economy into competing blocks. The era of ever-expanding international trade and capital flows appears to be giving way to an era of regionalization, redundancy, and strategic decoupling. China's financial repositioning is happening against this backdrop. It's not occurring in isolation. It's both a response to these forces and a force that will interact with them in complex ways. For investors, this means that simple strategies based on past correlations may not work as reliably going forward. The relationships between stocks and bonds, between growth and value, between domestic and international assets, all of these may shift as the underlying structure of the global economy evolves. This doesn't mean investing becomes impossible. It means investing requires more careful thought, more diversification, more attention to risk management, and more humility about the limits of our knowledge. If you already have a portfolio, if you own stocks, bonds, real estate, or other assets, you're probably wondering what you should do right now. The first thing to understand is that knee-jerk reactions are usually counterproductive. Selling everything because you're worried about a long-term structural shift is likely to hurt you more than the shift itself. That said, complacency is also dangerous. Assuming everything will be fine without examining your positioning is essentially hoping for the best rather than preparing for reality. So, what's the rational approach? Start with an honest assessment of your current allocation. Look at your exposure to different asset classes. Look at your geographic diversification. Look at your currency exposures. Look at the duration of your fixed income holdings. Look at the sectors and industries you're invested in. Ask yourself, if Treasury yields rise significantly, how does that affect my portfolio? If the dollar weakens over time, what happens to the purchasing power of my dollar-denominated assets? If inflation pressures intensify, which of my holdings provide protection and which get eroded? These aren't hypothetical questions. These are the scenarios you need to stress test against. For fixed income holdings, this environment creates challenges. Traditional bonds face risk from rising yields. If you're heavily allocated to long-duration treasuries, you're particularly exposed. Consider shortening duration. Consider inflation-protected securities. Consider diversifying beyond just U.S. government debt into corporate bonds, municipal bonds, or international bonds with appropriate hedging. For equity holdings, the picture is more nuanced. Stocks have historically been a reasonable inflation hedge over long periods, though they can suffer during periods of rising rates and economic uncertainty. Focus on companies with pricing power, strong balance sheets, and global revenue streams. Be cautious with highly leveraged companies or those dependent on cheap financing. Real estate can serve as both an inflation hedge and a yield-generating asset, but rising mortgage rates affect property values and transaction volumes. If you own real estate, ensure you're not over-leveraged. If you're considering adding real estate exposure, be selective about location, property type, and the terms of your financing. Consider your exposure to international assets. If the dollar weakens, foreign stocks and bonds will benefit U.S. investors when those gains are translated back into dollars. Diversifying globally isn't just about accessing different economies, it's about managing currency risk. Think seriously about commodity exposure. Gold has been humanity's hedge against currency debasement and economic uncertainty for thousands of years. It pays no yield, but it serves a purpose in a diversified portfolio as insurance. Other commodities, energy, industrial metals, agricultural products, also have roles to play, though they're more volatile and cyclical. Perhaps most importantly, maintain liquidity. In uncertain environments, cash is optionality. It allows you to take advantage of opportunities when they arise. It provides peace of mind. It reduces the need to sell assets at inopportune times. Yes, cash loses purchasing power to inflation, but being fully invested at all times is a recipe for forced selling during volatility. The goal isn't to maximize returns in the short term. The goal is to construct a portfolio that can weather multiple scenarios, that doesn't have uncompensated concentrated risks, and that allows you to stay invested through periods of uncertainty without panicking. Review your allocation quarterly. Make adjustments as conditions change, but avoid constant tinkering. There's a difference between being responsive and being reactive. If you're sitting on the sidelines, if you're accumulating capital and wondering when and how to deploy it, your considerations are somewhat different. The temptation when you read about major structural shifts is to wait for clarity, to wait until you know what's going to happen, to wait for the perfect entry point. That's usually a mistake. Markets don't ring a bell at the bottom. By the time there's clarity about what's happening, assets have already adjusted to reflect that reality. You don't get paid for certainty. You get paid for taking calculated risks when there's still uncertainty. That doesn't mean you should rush in blindly. It means you should have a plan. Consider dollar cost averaging, deploying your capital gradually over time rather than all at once. This removes the pressure of timing the market perfectly. It smooths out your entry points. It reduces the emotional burden of making one big decision. Think about building positions and assets that benefit from the trends we've discussed. If you believe in long-term dollar weakness, accumulate foreign currency exposure through international stocks or bonds. If you believe inflation will be an ongoing challenge, accumulate real assets, commodities, commodity producers, real estate, infrastructure. Don't chase performance. Assets that have already run up dramatically in response to these trends may have limited upside from current levels. Look for areas where the structural case is sound, but where current valuations still offer reasonable entry points. Quality matters more in uncertain times. Companies with strong balance sheets, consistent cash flow, competitive advantages, and competent management will navigate challenges better than fragile businesses. You may pay a premium for quality, but the premium is often worth it. Educate yourself continuously. Read widely. Seek out perspectives that challenge your assumptions. Understand that no one has all the answers. The experts who are most certain are usually the ones who understand the situation least. Start small. Test your hypotheses with modest position sizes. See how you react emotionally when those positions move against you. Ensure that your risk tolerance in theory matches your risk tolerance in practice. And remember that your timeline matters enormously. If you're investing for retirement decades away, short-term volatility is noise. If you're investing capital you'll need in a few years, you need to be more conservative. Match your strategy to your actual time horizon, not to the market's daily movements. Let's be direct about the behaviors that will hurt you during this period. Making investment decisions based on fear, greed, or headlines rather than rational analysis is the fastest way to destroy wealth. The financial media makes money from your attention, and fear and excitement capture attention. Don't let the emotional temperature of the news cycle dictate your financial decisions. Have a plan, stick to your plan. Revise your plan when facts change, not when emotions spike. Using debt to amplify your investment positions multiplies both gains and losses. In stable, predictable markets, leverage can work. In uncertain, volatile markets, leverage can wipe you out. If you can't afford to own an asset without borrowing, you probably shouldn't own it at all. This goes for margin in brokerage accounts, investment property mortgages, or any other form of investment debt. Reduce leverage before you're forced to reduce it. Having too much of your wealth in a single asset, sector, or strategy is betting that your worldview is exactly correct. Even if you're right directionally, concentration means you have no margin for error. Diversification is often derided as the only free lunch in finance, but that's because it genuinely works. Spread your risk. Accept that parts of your portfolio will always be underperforming. That's the price of protection. Investors tend to prepare for the previous crisis rather than the next one. People who lived through the Great Depression hoarded cash forever after. People who experienced the 1970s stagflation saw inflation everywhere. People who survived 2008 became permanently bearish on housing and banks. Don't let past traumas dictate your current strategy. Each environment is different. Learn from history, but don't become imprisoned by it. Being so worried about making the wrong move that you make no move at all. Sitting in cash indefinitely, refusing to rebalance, waiting for perfect information that will never come. Paralysis feels safe, but it's actually a decision. A decision to accept whatever happens passively rather than positioning yourself thoughtfully. You will make mistakes. Everyone does. The goal is to make small, recoverable mistakes while positioning yourself to capture opportunities. Believing that successful investing requires exotic strategies, complex derivatives, or insider access. The financial industry profits from making things seem complicated. In reality, the fundamentals of sound investing, diversification, risk management, long-term perspective, discipline, are not mysterious. Complexity often serves to obscure costs and risks rather than to enhance returns. Keep your approach understandable. If you can't explain your strategy simply, it may be too complex. Transaction costs, management fees, tax implications, these compound over time just like returns do, but in reverse. In an environment where returns may be more modest than in recent years, controlling costs becomes even more important. Every dollar paid in unnecessary fees is a dollar that doesn't compound for you. Be ruthless about minimizing expenses without sacrificing quality or diversification. Adopting an investment identity, I'm a gold bug, or I'm a tech investor, or I'm a passive index investor, and defending that identity regardless of changing circumstances. The market doesn't care about your identity. It doesn't reward loyalty to an approach. It rewards clear thinking and adaptability. Be willing to change your mind when evidence warrants it. Your investment strategy is a tool, not a religion. Beyond your personal portfolio, it's worth understanding the broader implications of what we're discussing. The potential erosion of dollar dominance isn't just a market issue. It's a geopolitical issue with implications for American power, global stability, and the architecture of international finance. The current system, for all its flaws, has provided a framework for international trade and capital flows. It's enabled unprecedented economic growth globally. It's created mechanisms for crisis response and coordination. A transition to a more multipolar currency system could be more stable in the long run, less dependent on the policies of a single nation, or it could be more chaotic, without a clear anchor, lacking the depth and liquidity that make the current system function. We don't know which scenario will unfold. Both are possible. Both have happened in different historical contexts. What we do know is that transitions create winners and losers. Countries with strong fundamentals, diversified economies, and sound institutions will adapt better. Countries over-reliant on dollar financing or dollar-denominated debt may struggle. The same is true for individuals and institutions. Those who remain flexible, who maintain diversification, who avoid excessive risk, will navigate successfully. Those who remain rigid, concentrated, or over-leveraged will face difficulties. This isn't about picking sides or rooting for any particular outcome. It's about recognizing that the world is changing and adjusting accordingly. One aspect of this situation that doesn't get discussed enough is the psychological challenge it presents. Living through major historical shifts is inherently stressful. There's uncertainty about the future. There's the feeling that the rules you understood are changing. There's information overload and conflicting expert opinions. This stress affects your decision-making. Anxiety makes you more reactive. Fear makes you more conservative. Excitement makes you more reckless. Understanding your psychological state is as important as understanding market dynamics. Build practices that support clear thinking. Limit your consumption of financial news to specific times rather than constantly refreshing feeds. Maintain perspective by zooming out to longer time frames rather than obsessing over daily movements. Talk to trusted advisors or friends who can provide outside perspective when you're feeling uncertain. Remember that markets have weathered major shifts before. The world has experienced currency transitions, geopolitical realignments, and economic restructurings. Economies adapt, markets find new equilibriums, life continues. This isn't the end of the world. It's a change in the structure of the world. Those are different things. Your job isn't to predict every twist and turn. Your job is to maintain the discipline to stay invested in sound assets, to avoid catastrophic mistakes, and to adjust thoughtfully as new information emerges. That's a job you can do regardless of what happens. With China, the dollar, or anything else, let's talk about something that often gets overlooked. Your investment timeline fundamentally changes what matters to you. If you're young, with decades until retirement, the long-term structural shifts we're discussing may actually create opportunities. Assets that are temporarily depressed by volatility represent buying opportunities. Multiple market cycles will play out between now and when you need your capital. Short-term turbulence is irrelevant to your ultimate outcome. If you're in mid-career, accumulating wealth, you have both opportunity and vulnerability. You can still benefit from long-term trends, but you also need to protect the capital you've already accumulated. Balance is key, maintaining exposure to growth assets while reducing concentrated risks. If you're at or near retirement, capital preservation becomes more important than maximum growth. You don't have decades for recovery if things go wrong. This doesn't mean selling everything and hiding in cash, but it does mean being more conservative, maintaining more liquidity, and focusing on income generation rather than pure capital appreciation. If you're in retirement, drawing down your assets, you need to ensure your portfolio can sustain withdrawals regardless of market conditions. Sequence of returns risk, the danger of being forced to sell assets during a downturn, becomes a primary concern. Diversification and liquidity are essential. Match your strategy to your timeline. The same event can be an opportunity or a threat, depending on when you need to access your capital. We've covered a lot of ground. Let's bring it together. China holds approximately $8 trillion in financial power. Over time, for strategic and economic reasons, China appears to be repositioning that power away from dollar-denominated assets toward a more diversified portfolio of currencies, commodities, and hard assets. This repositioning is happening gradually, not catastrophically, but even gradual shifts at this scale create ripples throughout global markets. Treasury yields may face upward pressure, the dollar may weaken over time, inflation dynamics may shift, traditional asset correlations may change. These are not certainties. They are possibilities that prudent investors should prepare for. Preparation doesn't mean panic. It doesn't mean selling everything. It doesn't mean trying to time dramatic moves in or out of markets. Preparation means honest assessment of your current positioning. It means diversification across asset classes, geographies, and currencies. It means maintaining liquidity for both defense and offense. It means controlling leverage and avoiding concentration risk. It means matching your strategy to your timeline. Most importantly, preparation means psychological discipline. The ability to remain rational when markets become emotional. The ability to stay invested when headlines are frightening. The ability to take action when opportunities present themselves rather than freezing in uncertainty. We are living through a period of significant financial transition. These periods are uncomfortable. They test your resolve. They challenge your assumptions. They require patience and adaptability. But these periods also create opportunities for those who remain clear-headed. Market dislocations create pricing anomalies. Structural shifts create winners and losers. Volatility creates entry points. You don't need to predict the future perfectly to navigate it successfully. You need to understand the forces at play. You need to position yourself defensively. You need to maintain the discipline to stick to sound principles even when they're being tested. The investors who emerge from this period successfully won't be those who made the perfect trade at the perfect time. They'll be those who avoided catastrophic mistakes, who stayed invested in sound assets, who remained disciplined when others panicked, and who had the courage to act when opportunities arose. The global financial system is evolving. The relationships between major economies are being redefined. The architecture of international finance is shifting. This isn't happening to you. This is the environment in which you're investing. It's the context within which you're building wealth. It's the backdrop against which you're securing your financial future. Understand it, respect it, prepare for it, but don't fear it. You have more control over your financial outcome than you might think. Not control over global events, not control over what China does with its reserves or what happens to the dollar, but control over your own decisions, control over your allocation, control over your behavior, control over your discipline. That control is enough. Stay informed, stay diversified, stay disciplined, stay invested in quality assets, stay focused on the long term. The world is changing. Your approach to navigating it doesn't have to. Steady hands build lasting wealth. Steady hands weather storms. Steady hands seize opportunities that others miss because they're too panicked or too paralyzed to act. Be the investor with steady hands. The shifts we've discussed will play out over years and decades, not days and weeks. You have time to position yourself thoughtfully. You have time to learn and adapt. You have time to build the financial foundation that will support you regardless of what comes next. Use that time wisely, not frantically. Wisely. This is not a moment for heroics or gambling. This is a moment for intelligent risk management, thoughtful diversification, and patient wealth building. You now understand the landscape. You understand the forces at play. You understand the principles that will guide you through uncertainty. Now it's simply a matter of application, of doing the work, of maintaining the discipline. The markets will have their moments of volatility. Headlines will alarm you. Experts will make dramatic predictions. Your emotions will be tested. When those moments come, remember what you've learned here. Return to fundamentals. Return to your plan. Return to the understanding that markets eventually stabilize, economies eventually adjust, and disciplined investors eventually prevail. China's $8 trillion repositioning is significant. It will have consequences. It will create challenges and opportunities, but it is not beyond your ability to navigate. You have the knowledge, you have the framework, you have the understanding of both the external forces at play and the internal discipline required. That's enough. Go forward with confidence, not the false confidence of someone who thinks they can predict everything, but the genuine confidence of someone who is prepared thoughtfully and is ready to adapt as circumstances evolve. Your financial future isn't written yet. It's being written now by the decisions you make, the discipline you maintain, and the perspective you bring to the challenges ahead.